Good evening, everyone. This is Wayne, and this is the video version of the trade report for Monday, February 12th, 2018. Well, the Bulls gave the Bears a run for their money today, and the markets closed higher. But do the Bulls have enough in them to make it move even higher from here? Stay tuned. Well, good evening, ladies and gentlemen, fellow traders. It was quite a Monday. Actually, it was quite a Friday and then a Monday. Friday looked like we were going to begin moving even lower in the financial markets, but we never did quite touch the low of the Monday low, which set up a double bottom in the market. Now, a double bottom is usually a point in time where price retests a low and then moves higher from there. But in this particular market environment with volatility so high and the other metrics such as the bond yield coming into play and the new reveal about the tax reform bill being more of a tax and spend rather than a tax reform bill, so many things are still up in the air. And when the market continues to move hundreds of points every day and volatility really doesn't relax, we can't be certain what is next. However, we can look at what happened and try to gain some perspective. Try to look at this market in a way that gives us some clues. Now, we're always trying to get answers from the market. The market is a perpetual mystery that reveals itself to us day after day. And for those of us who are in touch with the market on a daily basis, it reveals its mysteries to us in differing time frames. I, in particular, use a 15-minute chart. So the market reveals itself to me in 15-minute increments. Now, I also look at the pre-market and the post-market, or the extended session trade, to get a sense of the energy of the market, the bullishness, the bearishness, the participation of its participants. So today, again, coming off of the heels of a Friday that really took everybody for a ride. We need to take a look at that real quick just to get a sense of what I'm referring to. So last Friday, this market took a rather significant dip. It opened up off of a pre-market push to the upside, opened up flat, went a little bit sideways, and then proceeded to just explode to the downside. We had just significant and persistent selling. Then, once it found this level here, which is, by the way, the low of last Monday. Now, it didn't quite touch that level, but what it did do is come close enough to get algorithms triggered, which are the computer-driven buying models. And this market just went crazy into the close. It rose over 1,000 points from its low to its high. So going into the weekend, that provided some really nice relief. It took everybody's emotions and calmed them to some degree. And what it did more importantly was when the market opened up yesterday, Sunday afternoon, the futures market, and I did a live video on Facebook about this, the market started to go higher, went a little bit sideways throughout the evening, and then when the European markets opened, had a nice little push to the upside, and then continued to go higher as if it had taken the next leg up. Well, as soon as we got close to the open of the US market, we started getting a little bit of selling. Then buying started coming back in, and then more selling. We had no idea where the market was going to go today. And then we got a bunch of buyers that came into the market, and then it went quiet. We had some consolidation. And then one little pop here that tested the 2667 level, which is a level I've been looking at for over a week now. And it came back down, played around, went around, played around some more, went a little bit above it, came back down into the close, and now it's going sideways, right around 2654. So this 2667 level is the big reveal for today. 2667 is very good resistance for this market. In other words, 2667 is the next level to the upside that the S&P futures need to rise above in order for this market to go higher. Now, I look at the S&P futures because it is the greatest index for a sampling of the overall market. It has 500 of the largest stocks. The Dow is only 30. The Russell is a compilation of small cap stocks. And the NASDAQ, of course, is important, but it's predominantly technology stocks, so it doesn't really have a broad base of sectors and stocks in those sectors like the S&P does. So as we look at the market, the index of choice to view is the S&P. And of course, I watch the futures because the futures trade overnight, and they are also prone to moving with the Asian and European markets. So that's why they are so important to keep track of. Now, all the markets pretty much traded in tandem today. You can see how the NASDAQ, pretty much did the same thing as the Dow, and the Russell maybe a little more exaggerated because it just it's a little more feisty than the other indexes. And then, of course, the S&P futures, same story. So we have this little up, then dip at the open, and then a trail to the upside, almost into the close, and then it falls into the close. So as we're looking at this market, we're trying to establish some understanding. And when a market moves like this market has moved over the last week, we have a difficult time trying to really understand it. We know what we're watching. We can observe it and see that it's going through travails and, incredible moves up and down that on some level really don't make sense. But keep in mind that these markets are now moving with computer-driven trading models associated with them. Not completely, but that is a primary source of it. And so it's also trying to figure out where value is. I mean, it's gone down over 10%. It's gone past what is considered to be a textbook correction level. So theoretically, that should mean the correction's over, right? We should be able to go back up now and everything will be fine. Well, no, that's not how it works. There's still an enormous amount of volatility in the market. There's still a lot of uncertainty. There's still a lot of frenetic energy and fear in this market. Even when the market goes up so much, that's not a good sign. It means that it's going back up, yes, but when a market moves to the degree that this market moved today, it's like it's overshooting its target. It's not really doing what it should be doing in order to kind of maintain a level of resolve and I don't know what I can't think of the word. It's, just kind of restraint, I guess, is the best way to put it. So people are seeing what they believe to be are stocks on sale. They are opportunities, interpretively speaking, based on where the market is currently traded. But realistically, this market can drop like a stone again. And let me show you what I'm talking about. This is my Fibonacci charting program, Dynamic Trader. And what I'm always looking for on this is the downtrends and the uptrends and the support and the resistance. And those are the basic foundations of any technical charting program. You can see that when we started going down, we formed a downtrend line, and we've been keeping below that for over a week now. And we've had a lot of choppy market conditions. So when the market chops around like this, the trend line is what keeps us kind of in sync with the market, keeps us in line with what we can, to some degree, expect to happen. In a downtrending market, we look at the downtrend line, which is what I'm showing you here, this green line that moves down. So when price is remaining below the downtrend line, the market is still in a downtrend. Even if the market goes up, it's still in a downtrend. And then we have the Fibonacci lines, which give us support and resistance. And so kind of a 1-2 technical punch. We are looking at the 2673 level being resistance for the overall price movement on the daily chart. And we're looking at if price remains under this green downtrend line, we are still in a downtrend. And I will tell you right now, folks, I still have a line down here at the 24.47 level that looks like a very real possibility for price to try to find. Now, our low is right here. That is a rather significant low on the daily chart of the S&P. Now, this is an S&P, this is the S&P cash market. Now, the low here is 25.32. So what we're looking for is another retest of that low right here. And we're also looking for a move down because we are still under this trend line. As long as we're under the trend line, we're looking for lower prices. Now, if we move higher into and above and close above this trend line, then the game changes. Then we're looking for up moves. Then we're looking for a market that has decidedly and directionally shifted its bias to the upside. So just because this market has had a couple of days where it's had a fairly decent move from its low, and if we take a look at that, again, we see our low was there on Friday, and it came nicely back up again to close right here. And then today, it opened a little bit higher and went higher, found resistance and came back down again. But a couple of nice up days, but keep in mind, we've come down quite a bit. So we haven't really come back up all that much. So while I've got you here, what I do want to do is take a very quick measurement, and I'll show you how I do this. So a Fibonacci retracement is when you take a measurement from a previous swing high to the most recent swing low, and that gives us the levels that we need to look at in order to evaluate where we can potentially expect the next move. So we can see where the S&P closed at approximately 2654, which is in keeping with the 618. 618 is a primary level that price will try to find as a move higher is in gear. Now, it did come up to the 100% symmetry resistance as well. So we're also looking at that being a very important level too. And that's more important because it's from a deeper excuse me, that's from a deeper retracement. So we also have another level at 2685, and then 2727 is very important. And it's even more important than just important because it's a confluence of the downtrend line and the 100% symmetry resistance line. So this area right here is huge. That's 2727, and that is approximately, we're currently at 54, so this is about 73 points higher. Now if this market goes 73 points higher, the S&P, that's going to be a very happy time for the bulls, but that doesn't mean that we're out of the woods yet, ironically. So we've got a couple of days for that to happen if it's going to, but we don't know if it's going to. We don't know what's going to happen in the bond market, what happens in the news cycle, and the very last thing that's going to happen this week is the CPI report, which is the Consumer Price Index. And that is going to be, to some degree, some people think, a piece of economic data that will make or break this market. So that's Wednesday morning before the open at 5:30 a.m. Pacific, 8:30 a.m. Eastern time. So we'll see what happens. But right now, we came down from the high today, and we bounced back up into the close, but now we're moving lower again. So the market's still skittish, and that's to be expected. This market still has a lot of stuff to work out, and like I said, there's still fear, there's still uncertainty, there's still a lot of things going on in this market that need to be worked out. So we'll watch the market. We'll keep tabs on the market as always. We'll look for opportunities, but right now it is my firm belief that because of the exaggerated moves in this market, there really is no opportunities right now. So I appreciate you watching my video. I am going to begin doing more live videos on Facebook and YouTube. I feel like in these market conditions, it's important to keep everyone apprised of the nuances and the idiosyncrasies and the updates that are important in keeping with the information that everyone should have. And I hope I'm providing you with valuable information in a way that makes sense and gives you some actionable and valuable information. So, folks, thank you very much, as I said, for watching. Take care, good night, and good trading.